If you want to start building long term wealth, one of the simplest and smartest ways to do it is through ETFs. Here's what can happen with new investors: they spend weeks, sometimes months, stressing over their very first investment. Should it be Tesla, Apple, maybe Amazon? They read articles, scroll through social media, and watch dozens of videos, and oftentimes they end up more confused than when they first started. If that sounds like you right now, then stay tuned for the rest of this video. The truth is, you don't have to overcomplicate it. In my opinion, the best place to begin investing in stocks is with an ETF. In this video, I'll show you why ETFs make such a powerful starting point, why they solve one of the biggest problems beginners face, and I'll share the exact ETF I picked as the foundation of my portfolio, which I'm building from zero step by step right here on this channel. So let's start with the big question: why ETFs? It comes down to two words, and that's easy diversification. To illustrate this, let me give you a story. Let's look at Investor A. Investor A has $100 to invest, and they've decided it's time to start building long term wealth. Like many beginners, Investor A doesn't know where to start, and oftentimes, new investors tend to invest in what they know when they're starting out. Let's say in this case, Investor A drives a Tesla, they like Tesla, so they put the entire $100 into Tesla stock. Here's the big problem with that. Now, Investor A's whole financial future depends on a single company. If Tesla does well, sure, Investor A is happy. But if Tesla does bad or goes bankrupt, Investor A risks losing all of his invested money. And that's too much risk for even professional investors, much less someone just starting out. So Investor A does a little research and realizes, I need diversification. They sell part of their Tesla stock and spread that $100 across Apple, Amazon, Google, and a few more companies. Now they've got some diversification, which is better, but here's the real issue. Every time they want to invest more money, they've got to repeat that process, buying multiple individual stocks, keeping track of every one, and trying to maintain a balance. It's messy, it's complicated, and it's inefficient. This is exactly where ETFs are perfect. Instead of juggling trades, Investor A could simply buy one ETF. With something like VOO or SCHG, that same $100 instantly gets spread across Apple, Amazon, Tesla, and dozens of other companies, all in a single move. No extra steps, just one investment and instant diversification. That's why ETFs are such a game changer for new investors. The best part is, buying an ETF works exactly the same as buying an individual stock. You simply log into your brokerage, type in the ticker of the ETF you want, for example, VOO, and hit buy. That's it. One purchase, and you effectively own dozens or even hundreds of companies. And here's the beauty: every time you add more money, you just keep buying that same ETF. That simplicity is powerful because it allows you to actually stick with investing over the long term. Okay, so now you may be asking, which ETFs are worth considering? Let me give you a few of the most popular ETFs. The first one is VOO. This ETF tracks the S&P 500. When investors like Warren Buffett say, just buy the index, VOO is one of the ways to do that. The next one is SCHD. This ETF focuses on 100 high-quality US companies, all with a history of paying strong, consistent, growing dividends. And the last one I'll mention is SCHG. This one is more growth focused, focusing on companies expected to grow faster than the overall market. Each of these is a bit different in their own way. VOO is your standard index fund, SCHD is dividend focused, and SCHG is focused on high growth businesses. All three are beginner friendly, low cost, and provide instant diversification. Which one is right for you depends on your goals, but in my opinion, it's hard to go wrong with any of them. Which brings us to my personal portfolio that I'm growing right here on this channel from zero. The ETF I chose to start my portfolio off with is SCHD. I chose it because my goal for this is to build a portfolio that pays a stable, passive income stream in the form of dividends. And I think SCHD is the ETF best positioned to help me accomplish that. So here's where I'm at with my portfolio. It's still tiny, about $250. But that's exactly why ETFs are so powerful. Even with limited money, I can still get quick and easy diversification. I'm starting small, contributing every single week, and maybe one day I'll layer in individual stocks. But for now, I'm sticking with ETFs, investing money one week at a time and showing you how this account grows step by step. Your ETF choice might not be the same as mine. It depends on your goals and your risk tolerance. But if you pick one strong ETF, make consistent contributions, you're already ahead of most beginners. That's how wealth is built. Not by chasing hype, but by laying a strong foundation and sticking with it. So, what's the best way to begin investing in stocks? For me, It's with an ETF. Leave a comment if you agree or if you disagree. I'd love to hear your opinion. If you found this video valuable, or if you want to follow along as I grow this portfolio from zero, make sure to hit the like and subscribe button. Welcome to the compound journey, everyone. This is just the beginning. Thanks for watching.